I want to take a minute, welcome everybody to Are Your Assets in Sync? My name is Arthur Bush, the Chief Executive Officer of Vita Financial. So I'll introduce the other panelists today. The intent today is a panelist discussion where we're going to go through some content. If you have any questions, please post your comments and or questions or comments, and we'll be able to bring them up towards the end. There will be a point in between each panelist's discussion where we'll ask a question. If we can get the time to do it then, great. If not, then we'll push those towards the end of the workshop. So first, I'll introduce Stephen Bush, our Chief Business Officer here. We have Mr. Nicholas Benzer, the Chief Executive Officer of Benzer Capital Wealth, which is one of our sister firms. For anybody not familiar with Nick, Nick is on our investment committee within the organization, within the group. And he's actually he's our chair, he's our chair for the investment committee. Extremely intelligent advisor that I would absolutely recommend asking some questions to. Next, we have Mr. Drew White, which I know some of you guys have met or have seen the more recent post on Facebook about his title change. And then we have Mr. Dylan Baxter here as our paraplanner. So where is my money? So the distribution between cash, investment funds, stocks, annuities, and inheritances, real estate, the assets there not only have an asset allocation, but also have an asset location, which can change tax implications, how monies are invested, everything else like that. You may be doing this by yourself or working with a variety of brokers, agents, or advisors. In doing so, do they maintain the same level of the same strategy? Do they maintain the same level of eyes on your assets? And more importantly, do they have the same philosophy? We see sometimes where philosophies can combat with each other and can move assets in different directions. It's smart to diversify, but keep track of everything and adjust everything when situations change. So if we're not tracking and monitoring not only where our investment allocation is moving over time, but also what are we paying? What are fees and expenses inside of there? Are there things that we need to consider? A more cohesive approach may help improve returns and lower costs. Returns is something that people like to think about frequently, but fees and expenses are becoming a very, very important topic. Will continue to trend that way and have increased in importance over the past 5 to 10 years. So I would recommend absolutely considering that, or that's something that we discuss during our conversation. Now, you're not alone. $172 billion lost just in 401k rollovers to cash accounts. That was a study done recently that was talking about 401k distributions, the amount of tax liability paid on those distributions from people taking assets and putting it in cash when they really should not have been, or could have done some more comprehensive planning around it. So with that, I'm going to introduce Stephen. Stephen's going to talk more about the decentralized approach.
Yeah, absolutely. The issue with today's infosphere and environment that we live in is there are so many different sources of information, so many different channels of information that people take in. And honestly, it causes a ton of FUD. If you have not heard that term, I would absolutely recommend that you do a little bit of research, because it probably drives many people's decisions and reactions, fear, uncertainty, and doubt. And that happens inherently whenever you don't have a plan. Without a plan for your investments, you're absolutely at the mercy of the market. Your investment dollars are supposed to be working for you. And if you don't allocate your resources purposefully, it becomes really difficult to prioritize or even identify, your goals, because you're not planning. We see, in my experience, in Arthur's experience, everybody on, in the panel, we see this happen oftentimes when there are, again, multiple sources of information, multiple advisors, brokers, financial planners, agents in the mix across various firms. You got to think everybody kind of has their own interests, different rules to follow, different licensing. So clients will oftentimes receive guidance that isn't necessarily aligned, not necessarily with their plan, maybe not with the other advisors that are kind of in the picture. And that can lead to fragmented decision-making and fragmented results. This confusion is also compounded by the overwhelming number of options, decisions that need to be made. Like I said, there's so much information out there. So where do I invest? When do I pull money? How do I balance it all? The cost of this disjointed approach can be extremely detrimental to somebody's financial planning success, not just in terms of time and energy, but also financially. Like Arthur mentioned, cost, fees, multiple advisors means multiple fees, which can add up pretty quickly. Also, you got to think your different fee arrangements that you have. Sometimes people will pay us a financial planning fee to put together a really comprehensive plan. Sometimes they'll pay us to manage their investments. Sometimes it's both. You really need a coordinated strategy and plan to ensure that all of the financial aspects of your investments are working together and in tandem. And you absolutely risk paying more in fees, taxes, and FUD, more than necessary, as each account may have its own, tax implications, whole 9 yards. So the result of a decentralized approach to advice can be inefficient, costly, often, causes a lot of stressors, pretty stressful experience sometimes when you're getting information from different people that you trust, that conflicts. So it can erode trust, gains, a lot of things from your financial plan that, honestly, people work really hard to achieve. So that would be an issue.
Stephen, there's a question for you. How do you balance the client's preference to have multiple advisors versus your fiduciary duty as a financial planner? How do you balance the two?
Yeah, I think the first thing that you're gonna have to do is make sure that you set expectations of what you're actually doing for somebody. There are some very confusing nuances around fiduciary responsibility, and kind of what that applies to. So as a planner, I have to work really hard to understand, where are you getting advice from? Where are you getting other guidance from? Why? Why are you taking that? What are they doing for you? What are you paying for? We work really hard as kind of a general practitioner and quarterback, if you will, if people like that analogy, to help at least coordinate. So I would say you mentioned balance, really important to mention. Everything I just said does not mean that we can't work together. We work with clients that have multiple advisors all the time. The most important thing is that we are communicating with one another. So for us, a lot of times we'll offer joint meetings, we'll offer, constant lines of communication, answering questions. So the honest answer is, as an advisor and planner, it's our responsibility to understand where you're getting your information so we can make sure that it is aligning cohesively with the strategy and plan we put together.
All right. So next we'll move to Mr. Drew White. Drew White's going to talk about the benefits of using fewer or even a single financial planner. Drew, if you want to take us away.
Yeah, sure. So relying on like a comprehensive financial planning team offers benefits that exceed the norm of kind of traditional investment management and client expectations. When you have like diverse perspectives, subject matter expertise, clearly defined roles, you're not just relying on a single advisor per se, or trying to navigate a fragmented network of specialists. Instead, you have an entire office kind of dedicated to your success. While benefiting from the team and its resources, it's important that your plan is coordinated under like a primary planner. In our case, that's Stephen usually. Serves as your primary like contact, confidant for decision making and discussion. But Stephen's taking a lot of advice and input from the team that we have here. We believe the result there is more efficient, streamlined, ultimately more successful approach to managing your wealth and giving you the confidence that your financial future is in really capable hands. The cohesive approach allows for like a unified strategy. Each element of your financial picture is very carefully tailored to your risk tolerance, your family's needs, and your long-term goals. But we prioritizing cash flow management, addressing risks and vulnerabilities initially, and then finally focusing on wealth accumulation. You initially build a really strong foundation that supports like immediate stability, kind of the risk management piece, and that will also promote long-term growth.
Thank you, Drew. I think one thing too that always pops up for me that I really enjoy is, like, as a planning team, as for all of us, is we all disagree with each other. And I think that's wonderful. I think that's great because ultimately the client wins every time, because disagreements don't mean that we're not able to come to a solution. It's that we can talk through multiple solutions and understand them thoroughly within the organization, within the group, and give the client the advice and counsel that they need that's more subjective. So Drew, we did get a question for you. How do you go about finding or vetting a financial planner? So many advisors market themselves this way. How can we make sure that they are comprehensive or holistic in their approach?
That's a good question. Every financial professional out there does want to be marketed as an advisor. I think the first thing I would say is don't be afraid to interview your prospective advisor and ask really direct questions. Look for what we call IAR status, or investment advisors representative status. Make sure that they're qualified to charge for financial advice. The reason there is that they have to act in your best interest if they're licensed that way, and if they're engaging you on a fee planning basis, all the decisions and the recommendations that they make for you they're bound by a fiduciary obligation to act in your best interest, not their own. And then the last thing I would say is don't be afraid to get a referral. We as financial professionals strive to be referable. I think that it's advisable to find someone that you like and trust, figure out if they're working with somebody, and that would likely be a good fit for you, as long as their why matches your why. I know here at Vita, the most valuable thing that we can receive is a referral, and I know that across the industry, something that financial professionals work very, very hard at is being referable. So that's how I'd answer that.
Awesome. Thank you, Drew. Are there any other questions that anyone has? If you have them, type them in the chat box now, or you can wait until the end. Next, we'll go over to Mr. Nicholas Benzer. Nick is going to explain how technology can help in the planning process. Nick, if you want to take us away.
Technology really is the new currency. I mean, data is the new currency in this day and age, and we strive at Vita Financial and Benzer Capital Wealth to have access to data in real time. Once we use tools like e-money, like Dylan showed, and clients on here have had experience with e-money, and you guys have seen the power of how it allows you to see your entire world in one place, really see the big picture. It consolidates the data. It allows us to track results and measure results for investment performance. Could even be insurance policies. Whatever you're looking to track, we can get it all in there. Savings rates for our clients as well, growth of emergency funds and the importance of that. And it allows us to integrate across different platforms. So whether it be your Fidelity 401k, Empower 401k through your respective employer, it could also be your bank accounts. So we can make sure that, again, there's growth and it's all staying in accordance with the financial plan. That really is where we create our value. We utilize a lot of tools at BCAP Wealth and at Vita Collective, things like e-money, like you saw, Y charts to track economic data. On a day like today, we're constantly viewing data and what decisions are made, economic indicators, so we can put our clients in the best position. Morningstar, when we're looking through reviewing clients, prospective clients as well, and say, hey, does it make sense for us to look at your portfolio, and does it make sense to maybe move away from your current position? That way we don't have any overlap. We have seen time and time again with 3 different portfolios, all with very different investment strategies, and it ends up at the detriment of the client and their goals in the future, and actually sets them behind, and they had no idea because they could never see everything all in one place. So with us utilizing tools like that on our investment committee, we have detailed insights and data that just allows us to do our fiduciary duty for our clients.
Awesome, Nick. And again, I'm going to say this every time, but any questions? If anybody has anything, put them in the chat box. We do have this question, Nick. How do we leverage technology for investment portfolios?
Yeah.
And we'll go ahead and answer that one, and I'll go through the next one.
Yeah, oh, we got a two-parter. Very cool.
Two-part.
As I mentioned, we're constantly reviewing data, and our technology allows us to see things in real time. We live in a very fast-paced environment where information's at our fingertips. We can look at a small device in our hands and see things from all around the world. We want to make sure that we are now integrating that information into our clients' portfolios. We talked about it at the onset. Right, today we had a Fed decision that was a little bit different than what most people were expecting. We saw some tea leaves a couple of weeks ago, like I mentioned. 2 weeks ago, we started to see some action that a 50 basis point rate hike could be in the cards, and it's because of the data that we utilize for our clients. So we weren't as surprised as most by things like that.
The follow-up question there was, how does the data in e-money allow us to keep our clients on track?
Well, I think that's a really good question. If we're not able to view things in real time, we could completely miss the boat for our clients' financial objectives and their goals, especially with this volatile environment that we're in today. Somebody who's preparing for retirement, somebody who may be moving to a new state because they got a new job opportunity, whether it be within their company or outside. We are able to make sure that we constantly have them in the best position. We can de-risk their portfolio if we have all of the information. But if we're only looking at one specific silo, it's impossible for us to do our fiduciary duty. I always think of analogies, right? Well, if I'm looking at, one game, right? It's football season. So we can go back to this. And I'm going to pick on Arthur because I know he's a Dogs fan. But if I'm looking at Georgia Bulldogs of their Kentucky game and they won by 1 point, I'm saying, oh, this team might be in trouble. But if I look at their entire picture and say, hey, you know what? This team's won a couple of national championships in the last couple of years. Now it allows us to understand, hey, we all go through tough times, but tough teams last. And we have the same philosophy here. If we look at things in small pieces, it doesn't allow us to do our fiduciary duty for our clients.
I don't remember that game. I think we had a bye week last week.
Yeah, that's right. I think a couple of players thought so too.
Yeah, they didn't show up. Yeah. Stephen, I know you wanted to ask.
Hey, Nick, I have it's a three-parter. I've got a quick follow-up. You mentioned volatility. What are the three key metrics you find most valuable? When you're looking at economic data, if we're looking at VIX or any of those things, what do you find most valuable?
Man, that's a good question. It's kind of like asking somebody, at least, the nerd in me thinks it's kind of like asking somebody, hey, what's your three favorite songs, right? But
Sure.
if I had to pick three, one, of course, we all know, which is the VIX. The VIX is a volatility measure and some people view it as a risk measure. It's something that we track on our dashboards every single day. We have conversations regularly as an investment committee. The second, we are very big believers in flows, right? Flows of consumer spending, which makes up 70% of our economy in the United States. And as a global spender, if the United States economy is booming, usually the world does pretty well. And one of the things that we saw come out, kind of tying it into today, is retail sales numbers. Jerome Powell got onto the podium and said, hey, 50 basis points, some people may be scared. You may be thinking, hey, is there something wrong? Well, retail sales numbers that came out within the last week were actually showing a very strong consumer in the United States. So that would be the second one. And the third one's always the hardest. If I had to pick one, it's very difficult. I would probably say, I'm not going to say the Fed funds rate, but I would probably say the 2-year Treasury and the 10-year Treasury. So I'm going to give you two, but they're bond yields.
That's fair. We can count them as one. Treasuries. We'll
Yeah,
count
we'll
them.
count them as one. So treasuries, it just allows us to look at things like, hey, what's the price for mortgage rates? What's the price for business debt? And hey, is there a discrepancy? And if we see one, that usually shows that something may be coming in the coming months. So like a long-winded answer, but hopefully.
No, thank you very much, Nick. It's nice not to be the smartest one in a call. I appreciate that.
Thank you, Nick. So we'll move on to the last two slides, and then we'll open up the floor for questions. So should you decide to consolidate, we know a good financial planner, we know a really good group. Comprehensive planning, we offer a breadth of experience and coverage. The personal approach, tech-driven models, and individual accounts and investments, we don't have a one-size-fits-all strategy. We don't deploy that. We want to use things that are unique because you are unique. People's financial situations are different, so your financial plans should also be different. Specialized teams, multiple departments covering all aspects of financial planning. We know you and we know your assets. I was mentioning this earlier with the diversity of the group and thought and the way that we communicate with each other. It's not everything is an agreement. Not everything is that this is 100% the strategy that we need to use. We discuss it internally and figure out the one that's going to be best. Our financial tools, comprehensive planning tools for professionals and clients. I know clients, people on the call, and people, I recognize a lot of the names that are on the call right now and see some that I haven't quite met yet, and maybe I will meet them in the future. But e-money is very client facing, very in front of you and in your face, but there are 100 different systems that we have that we use to make sure we're getting advice and counsel that's in the client's best interest. Y charts, which is one of them that Nick was alluding to earlier, is an extremely powerful data analytic tool that would probably confuse everybody on the call except for Nick and maybe one or two other people that are on the panel. I don't even know what they're looking at most times, but Y charts is an extremely powerful tool. The investment committee, a team of professionals covering all aspects of asset management, from investments, risk management, or risk mitigation, privacy, and beyond. Sorry about that. With the investment committee, it's the same thing with our teams and our groups. Very diversified thought, professionals from multiple different disciplinaries that provide insight, advice, and counsel, not only to the committee, but to our clients. We're experienced in it day in and day out, every day, moving through, communicating, and getting the information that we need internally and externally. It's the entire point of the group, to make sure that we can provide advice and counsel on a team-based approach to all of our clients. And if we want to go to the last slide, next steps. For current clients, you can always schedule a review. You guys know if you have any questions immediate that we need, you can always reach out. We also have our quarterly reviews and everything that's fairly consistent. So if you have any questions, of course, you can reach out and get some time on the calendar to have a discussion. For prospective clients, there's no obligation introduction meetings with the team that they can talk through us and talk through the process. And then for referrals, if you know anybody that is having an issue or says complaining about too many financial decisions, or if they're discussed this in a barbecue, whatever it is, we of course would love to get the information, and we can help them in the same way that we've helped you guys. Are there any questions? This is the point now where we open up to the floor. Is there any questions? So if you have some time, go ahead and type it in. I have a couple that have come in. Are there any potential benefits to having multiple financial advisors? And I'll give this to the panel. If anybody wants to raise their hands, I'll ask a question again. Are there any potential benefits to having multiple financial advisors?
I think that you touched on it in multiple ways, but from my perspective, I think the diversity of thought, having additional eyes, additional perspectives. Dylan and I, for example, Dylan being lead paraplanner, he is critical to maintaining many of the plans, and it's really, really helpful having somebody who knows this stuff, works in the data all day long, has a lot of taking CFP coursework, taking advantage of, growing their education and stewardship in the industry. Adding that to the portfolio of thought allows us to make sure that we're providing, the best advice for people and clients. So that'd be one.
I did just think about the dichotomy there too of we have a centralized approach as a team where it is multiple advisors, but we're taking the steps forward as a team, multiple advisors. So the perspective of the question was interesting to me of whether it was talking about us as a group or us as an individual coming in with another planner that's outside of our organization. So I think the dichotomy there is interesting. The approach that we take, team-based to move forward together, is different if we have advisor A and advisor B within different organizations, don't have the same data, tools, resources, and anything else. Dylan, I see you raised your hand. You might have a different answer if you want to go ahead.
I don't know if it's a completely different answer, but maybe a little bit of a different spin. I do think there's a potential benefit of specialization between advisors. So if someone has a really good tax advisor, one, we're always looking for recommendations, so let us know, because those are hard to come by. But if someone has a really good legal advisor, a really good attorney, a good financial planner, so I'm actually kind of opening up the scope a little bit more than just purely financial investment management, financial planning. But I think there's a lot of benefits to having a core group of good advisors. I think one of the benefits here at Vita is we already do have that, right? We have kind of specializations internal to the firm, people who are the go-to to ask about this. You can probably tell Nick Benzer is a big go-to for when we have investment questions or we want to run something by him. He's a really big resource. Or if we have insurance questions, there's plenty of people here. Or if we have retirement planning questions, we all have specializations within the firm. But I do think that specialization is a benefit that people have through multiple advisors. But you can get that through one firm like Vita.
Yeah, and the internal and external resourcing, I think, is also important there. So it's not just us as an internal organization, but we utilize and leverage our external resources as well, whether that's with a broker-dealer relationship, whether that's with a wholesaling relationship, or to even different just conglomerates of information, which all of that exists, where we're not leveraging only ourselves internally, but we're leveraging everything on the outside too. And this industry is a relatively small industry. I have advisors that I've known since I've been in the business that I still call to ask questions, and we still enlist the assistance of like I mean, I know some people know this name on here, but it's Scott Greenfield. We still get the assistance of people that have been in previous organizations that we have great relationships with. And we have no shame in knowing whenever we don't know, and we'll absolutely reach out and ask questions internally or externally. That was the point of that. So I did get a question. The question says, if I sign up, where should I move my assets to avoid fees by other advisors?
Yeah, I'll take this one. I think that's a great question. Whenever you're going through the process, communication is critical. And so if that is something that you're concerned about, effectively communicate that with your advisor, effectively communicate that with the entire team so we can make sure that we put that as one of the top priorities as the financial planning process kicks off. Where to move it. If you're already with another advisor, you can just move it into cash. So that's actually one unique area that if depending on the type of account, just to be clear, where there won't be any type of fees accumulated with that. You can transfer it into a account. So for example, if you have an IRA and that's what you're getting charged a fee for, you can actually move it into an IRA at Fidelity or Vanguard, or move it directly into the Vita team at the onset. We'll bring it over in kind. If it is a taxable account, just be aware that those accounts do incur taxes. It's not something that's deferred. So again, when going through the process, that's something that will be identified, and we can move it over in kind so no taxes happen until we get to that point in the process, whether it be with Vita or Benzer Capital Wealth, so we can make sure that there's not going to be a big tax bill coming through the pipeline.
It's a good point, Nick. There's the tax mitigation, I think, is extremely important because it's not always that we move non-qualified assets or taxable assets and we just sell out of positions and put them in models, because you can dramatically affect somebody's taxable situation by doing that. So transfer in kind is something to make that the tax liability that's going to come due eventually a little bit more systematic. We also have access to some alternatives that could help alleviate some of that, or some tax overlays. There's tons and tons of different mechanisms that can be used. So thank you, Nick. That's great.
Yeah, and I'll just say this real quick, just for those who don't know what transfer in kind. Sometimes we talk finance jargon, we don't even know it, but it just means we move the assets over as is.
Thank you, Nick. Thank you. I didn't mean to do that. Any other questions? What else do we have? I see one. Is it hard to consolidate my assets in the real world? So this is talking about the actual logistics of it. Drew, I think that's a perfect question for you. Is it difficult to consolidate assets in the real world?
It can be time consuming. There's a lot of paperwork initially involved in those types of things. That's kind of my channel of the business, is getting things implemented and moved over. But the reality is, if you're willing to put in the time and the effort of sort of being educated as to how these things move around, how they land in certain places. One area that we've been able to help a lot of clients in is most clients are not aware that even in a qualified plan, there are provisions for them to be able to move their money out of that, say, 401k or IRA and into management by an individual team or advisor. And so consolidating assets with the use of some of the things that we talked about, whether it be in-service distributions from a qualified plan, or there's quite a few qualified plans now that will allow you to self-direct, meaning you can move those assets to an advisor of your choice, which really increases the number of investment options that you have. And you mentioned something earlier, Arthur, an area where we've been able to help people, or sometimes inside their qualified plans, they have highly appreciated individual securities. We can address that with them. There's also there's a lot of opportunity out there, and I use that kind of as a pun, but we've helped people with qualified opportunity zones to help offset tax liabilities, 1031 exchanges, any number of ways to sort of mitigate tax impact. But the most important thing with regard to consolidation is we use eMoney to make sure that you have a dashboard where you can see everything in one place. And it really isn't all that difficult to consolidate your assets. It's more a matter of the time required to make it happen. And once they all land in one place and we have a cohesive strategy, it actually, most clients feel that that's time well spent.
Yeah, I think the time spent pales in comparison to the amount of money spent whenever you're not doing it efficiently. And that's ultimately what we're trying to accomplish, is how do we make assets as efficient as we can, as efficient as possible. Okay, we have another question. How do you handle a situation where a client is receiving conflicting information?
Communication. Sunlight is the best disinfectant. What I find to work best is we all get in a room together and talk about it. It's why we want to keep open lines of communication with other advisors, planners, whether it be Dylan tax advice you mentioned, if we're talking with an attorney about estate planning, business planning, anything like that. What we find works best, we talk to the client, inform them on all the options, all the different things out there, give them the recommendation of what we think works best. And then we have that conversation, together, ideally. Sometimes other advisors may not necessarily be comfortable with that. To that, my response would be, I would be uncomfortable with that if I was the client. It's my honest response. But ultimately, to be super clear, I'd also respond by saying one of the most important pieces of this relationship is trust, and being able to feel comfortable and confident with who you're talking with. So we don't want to approach that conversation from a hostile perspective. It's certainly not that. It's more of, here's the options out there, here's what we see from our perspective and what we have under our purview, because Nick, you made some good points about data, and the difference in advisors absolutely affects the tools and the data that they may have access to. So they may not be mentioning strategies or recommendations to their clients because they don't even know that they need them or that they're even possible. So a lot of times we find that when we get in the same room together, typically we all get on the same page, and what we've proposed or are discussing, makes sense. And so I think it's best for us to all get in a room and talk about it. So.
Thank you, Stephen. Dylan, you had your microphone unmuted. Did you want to add to it?
Yeah, I was going to agree with Stephen and kind of went over everything I was going to say for the most part, but just to add on to that, not only just getting a room talking about it, but then from a client's perspective, making sure that the advisors are telling you why they're making the recommendations of the conflicting advice. I think you'll have a much better understanding of what you want to do based off understanding why the advisor is making that recommendation to you. And then at the end of the day, the client, who is really the captain of the ship, right? It's their resources, it's their assets. They make decisions, we make recommendations. They'll be able to make an informed decision about what best meets their goal by understanding the underlying reason. And because we can probably think of a million examples of conflicts, right? In 2022, cash went up to getting 5%. So there was a huge argument in the investment world. Hey, do I move everything to cash and clip 5%, or do I stay invested? Now we have hindsight, and we know if you stayed invested, you did really well. And with the cash, you might be happy, you might not. It depends on your goals. But I think understanding the potential outcomes and why they're making that advice and their expectations will offer a lot of light to the situation, what the right answer is going to be.
Thank you. Thank you, Dylan. Are there any other questions? Anything else? If you have anything else, type it in the chat box now. If not, that will be I think that would be the last question for the evening. We appreciate everybody's time. I know it's, these things start at 5:30 Eastern time. It's always, you got to take times away from your families. So again, I really appreciate everybody's time and giving us the respect of coming to these. I know we continue to host them, and we'll continue to host them to be as educational as possible for our clients. And then for any people that, if there's somebody on the fence and they want to come in and visit and see what we have to say as a group and as a panel, we're always going to continue to host these things to get people comfortable. That I actually really like the panel discussions, the panel conversations. So if anybody has any other input, thoughts, questions, I see there's like a hand. Was somebody raising their hand? Did anybody see that? Oh, is that you, Nick? Nick, your hand is raised. Okay, anything else while we close up? Any other questions, thoughts, anything like that? All right, let's go ahead and close up. It was good seeing everybody in the panel, and then everybody that attended. We appreciate the time.